What if you could turn a winning stock into a permanent, tax-efficient income stream with zero capital at risk? That is exactly the goal behind my Alphabet position. By strategically rotating my principal out of high performance like Google into other high quality growth assets, I have been able to lock in my gains while holding on the long-term potential of the stock. And how I am using the NISA here in Japan to minimize my taxation and make every cent of those future dividends work for me harder. And yes, Google pay dividend since 2024. I didn't buy the stock for the dividend, it just happened that they started to pay dividends. So you can see in my NISA, I receive dividend for 13 shares because now I own only 13 shares. The dividend per share is 0.22 cents. It is being taxed 10% by the US government before it comes to me. I get $2.57. I want to show you, this is, I am holding 13 shares right now of Google. If I go down to show you my previous ownership was in March, I had a total of 26 shares. Now I have only 13 of them because I was very, very profitable. Indeed, I was over 150% profitable. So what I did is I sold half of it, which means I took the house money. This is what is called the house money. I invested into Google some money. So let's say it was 400,000 something, and then it more than double. So what I saw is, okay, so now it's more than double. I got my initial investments. So what I did is withdraw the amount which I did invest. I think I took a bit more. And now what happened is it is running my current 13 shares are basically the profits working. And those profits are generating also some dividend. This is a coincidence. I'm not holding it for the dividend. It's just good that I receive some dividend, by the way. It is always good to receive a bit of money. And since it is sitting in the NISA, it is only being taxed by the US government. It's not being taxed by Japan. As you can see here, it shows zero. So zero tax in Japan. Now moving to my portfolio. Shown on my Google Finance. It's only me who can see this, but I'm sharing it because it's more easy to understand visually than on Rakuten. But basically I record all my trades from Rakuten. I record it in my Google Finance, so then I have a good screen view of my current portfolio. So Google is now 11.48 or 11.5% of my portfolio, which means the money I had, the profit from the profit, I did some investments, including one which was I very promptly closed it. It was a QXO, so if you look at my previous video, you will see I'm talking about it. I took some loss. And then with the remaining of the profits, and also I always have a bit of cash available on my trading account. So if I see an opportunity, or if I see some good dips, it gives me an opportunity to get into a stock or add up to any stock. So what I did with the profit, or I mean with my initial money from Google, I bought Berkshire. It says here BRK.B. So it is now 5.8%, and so I bought 5 shares of Berkshire and 40 shares of Uber and 5 shares of Amazon. So this is a visual screen. So if I go like this, you can see easier. So Amazon is 5 shares. I bought them, and so obviously if you do the calculation, it's much more than 400 or 500,000 yen. Is because, as I said, I always have some cash ready to work on my shares. I mean on my portfolio. So this is why the numbers don't add up. It's because I always have a bit more money available. But this is how I use the money I took off from Google. So you understand now? So the profit from Google are running perpetually. It's bringing some dividends, but the dividends are not big. But anyway, it's just add up. And my Google position is inside my NISA. It can run for until I die. If it goes to zero, it goes to zero. If it goes up, it goes up. So the profits are really good there. So the idea for me is to keep growing my NISA this way. Like try to find good growth stocks and then invest in it, and then when it gets double my money, I withdraw my initial investment, and then it's let running the profit for forever, perpetually. So the only drawback, when you own US stocks, you get withdrawn 10%. So if you find good Japanese quality stocks and you can hold for a long time, eventually they might grow enough so you can withdraw the profit and keep them running. So then if it's in the NISA, you don't get tax from the Japanese government nor from the US government. So it's basically 100% free is profit, as long as it is inside the NISA. If it is not in the NISA, if it is just in your normal taxable trading account, obviously you will be taxed the 20.315% from Japan, and if it is a US stock, you will be withheld 10% tax. So this is the idea. So this is how my current portfolio looks like. This is how I got my Berkshire, my Uber, and my Amazon. And I look, well, today they look green on the screen, but it doesn't matter on the day basis because I'm not a day trader. I'm more a medium-term investor, I would say. I try to invest in company that I feel comfortable even if they go down, because I have conviction in it, and then I will probably add more as they go down. I will build up a bigger position. It is what is called dollar cost averaging, and when they go up, it's also probably I'm going to add up to it. This is like watering your flowers, and if I have some losers which I have lost conviction, I will cut them, like you cut the weed and you keep your flowers growing and you water them. So I hope I explain very well how I make my portfolio works and how I optimize my NISA. This is not trading advice, it's not financial advice, it's just showing you how I do for my personal case with my own portfolio in my own situation. We are all in different situations, so please do not copy me. If you can be inspired to or give you some good ideas, please subscribe and give me a thumb up. Thank you.